You can't take it with you when you're gone, so how do you make the most of it while you are here? It's time for Your Money Matters with Sam and Dieter from Harness Financial.
I'd just done the same thing that Sean does every time there.
Maybe we should get that cut out.
Yeah, I don't know. We just need to get used to it. Welcome back to the show, lads.
Thank
Always
you.
good to have you here. On the menu today, KiwiSaver.
That's
and
right.
I actually couldn't believe my luck when I saw the notes for this because I'm useless with this. And it's one of those things that I think most people just kind of set and forget, let go. I don't know whether that's the most ideal thing to do. That's what I hear. But there's all sorts of stuff that you can actually do with it, who you choose to manage it, where it goes, that sort of stuff. So I guess just start by what is KiwiSaver? What's the best way to use it?
I think the first thing I'll say is, well, Ben, we're here to help.
Yeah.
We're here to help.
Well,
mate.
that's a relief. Yeah.
It's going to be okay, you know? And
Yeah.
also, you're not alone.
No,
Yeah,
because a lot of people, my brain just turns off when it comes to this stuff. I've got, I can put a little bit of money into it each week because I don't even have to do that. I don't even have to worry about that. But the minimum and maximum contributions, the government contributions, who you choose to manage it, that's when I kind of tune out.
Yeah.
Yeah.
Where do you want to start, Did you want to start with myth busting?
Yeah, let's start with a bit of myth busting.
A myth that we hear from time. Actually, before we jump to that, this, my friends, is general conversation, general advice, not personalised advice. For personalised advice, please be in touch. But first myth is, hey, I've heard that KiwiSaver is a good way for the government to steal all your retirement money, and you're never going to see it. Is it true?
I have heard that, and I've heard people trying to get it out because they might just get taken. And
Who takes it? Jacinda or Chris or?
the funny thing when people refer to government, it has an amorphous sort of non-personal reference, but ultimately government just has people in it. But no one really. All it is ultimately is a pie fund with a few.
What is always blow on the pie?
Yes.
What is a pie fund?
Yeah, it's a number we use to determine. No, it's
Portfolio investment entity fund, which
Yes.
means what?
So basically what it is just a tax structure in which a unitized fund sits, which has tax advantages. So instead of being all taxed in your hands at whatever nominal or effective rate is in your hands, it gets taxed at a rate that is based on your income bracket. So
Right.
whether it's 17.5% or 28%.
Right.
And for higher earners, that can be a lot less than your effective tax on a salary, a PAYE.
Right. Yeah, you might have seen a pie savings account at your bank. These products with the right advice can work in your favour. And so you're saying that the KiwiSaver product is a form of pie, essentially.
Yes,
Yeah.
I think it was a great intervention, a great sort of policy that was put in place back in the day before my time, before I got here. But what it's done is it's given people exposure to investing.
Yeah.
Now, New Zealand is traditionally property, term deposits, and your own business, which ultimately is not always treated as an asset. And that was just what you used. And there's a lot more options out there, and people are getting exposure to what it's like to invest in a format that's relatively well managed. There's a lot of governance over it. There's a contribution rate, Ben, as you were saying. You're contributing in a way that doesn't hurt you, but you still get a benefit and see what happens. And we've seen a branch out into things like sharesies, where people are getting a little bit more adventurous and picking a bit of Tesla and whatever it is. But they're also getting hurt there. But it is creating a broadened horizon of options.
Ben, what comes to mind first when you think of your KiwiSaver?
Yeah, well, I was just going to ask because I kind of always thought of KiwiSaver as a savings account, but it is actually invested for you, isn't it? Depending on who you put it with. So what goes into investment in KiwiSaver? What are they usually putting it into? Is it just securities, like the same sort of stuff that you would do on sharesies?
There's ultimately 4 asset classes you can have. You can have equities, you can have listed property, you can have bonds and fixed interest. Now,
And outside of KiwiSaver.
and outside of KiwiSaver.
Yeah.
So that's pretty much the 4 categories if you don't go into sort of, other derivatives, etc. But those 4 things, bonds and fixed interest will be your income, your low risk sort of conservative portfolio.
Like term deposits and things like that.
Well, no, a bit more, but bonds itself will be a little bit opposite to term deposits. And on the growth side, you've got equities and listed properties. So,
What do you mean by equities?
So equity companies. So if you go down with
shares.
New World, you just walk down the road and any company, AT Milk, you look at ANZ shares.
Right.
Everything we consume and use ultimately can trace back to a list of companies that you can invest in.
Yeah.
And what are the sort of the different types of funds you can have? I can see there's growth, balanced, aggressive. And what stage in your life do you think that those apply to? Because I think I'm in now an aggressive one. I recently changed it over because I was looking at my KiwiSaver number for months and it wasn't moving, and I thought whoever's doing this is useless. And so I changed it up, and it's gotten a little bit better. But I like to think that because I'm kind of a young guy, if I lose it all, I can just make it back. I back myself to make it back later on in life. Am I just being an idiot, or is that...
No, you're not. But, it's funny. A lot of the time, people choose a fund name that sort of reflects their personality. I'm an assertive guy. I'm aggressive. I'm a balanced
I'm all
individual.
about personal growth. There's not a lot of analysis that goes into it from my point of view. Yeah.
Dieter, you'll talk about this in more detail, I know, because you're so passionate about it. But I've heard you say so many times that one of the riskiest things you can do is, depending on your age, be in a conservative fund. So a lot of people are actually high risk in a conservative fund. Why is that?
Because your biggest risk in the long term is the ability to maintain purchasing power. So we all know, we saw during COVID, when you go to the shop, and over time you will have to spend more and more every time you go to the shop, every time you put petrol, every time you do anything, it costs more.
Yeah.
So your money's kind of got to keep up with that. Otherwise, your money's going backwards, but your costs are going up.
Right.
So how do you actually maintain the ability to afford to live? And you're not going to do that with conservative in the long term.
Yeah. Yeah.
So you need to have assets that grow to counter inflation and the cost of living increase.
Sort of reminds me of the parable of the talents. Do you know that parable?
Yeah, very well.
How does that work? What does that parable talk about?
We're basically talking about what are you using with what is given you. So whether it's one, I think it was 5 and 10.
Right.
Can be corrected there. But if you're going to have that and you're going to make it work for you, you will have the benefit and reap the reward of working with what you've given.
Yeah.
If you just put it in a hole in the ground, you're going to have the same, but ultimately it gets taken away.
Yes, because if you bury your money, then it depletes in value. If you give your money to the bank, it holds some value because it keeps up with inflation to an extent. But unfortunately, inflation is outpacing it.
I was actually thinking about this, and this is going a little bit off into the weeds here, but that's fine.
That's fine. We got time.
We got weeds.
Yeah, we got plenty of time.
Weeds like I've got here. So basically, companies on your stock market are linked to scarcity in resources. So they always need to use resources to produce something that is then sold. They can't just make things out of nothing. So there's a cost and there's a limitation of how much they can produce, and that improves the technology. So that is always going to give you a foundation and true value within a stock market. Currency, and especially fiat currency, is linked to nothing really. So, if there's an increase in government debt, an increase in money supply in the economy, you're devaluing every single dollar. Every time there's more money put in the system, you're not increasing the amount of resources. You're just increasing the amount of cash in the system, so it buys the same resources. So ultimately what you're doing is just reducing the value of every dollar.
I will say, I just remind everyone, people can ring in if they want to talk to you guys. 0800 33 2283. There's a few texts here. What can you use your KiwiSaver for? Someone here asked if they can use it for dental work. I know you can, I think, take some out if you want to buy your first home. Is that correct?
If your teeth are so bad that they're killing you, then it's possible you might be able to withdraw your KiwiSaver under hardship.
Usually, yeah.
But no, you basically need to be terminally ill or under immense financial hardship to withdraw your KiwiSaver. But there is another thing you can use it for, and people have been using it for this it's all the rage, really. That's buying your first house. You can do that.
Would you recommend doing something like that, or would you guys say it would be better to just continue putting money into that and leaving it until you're 65, which is the more boring route, but probably the better one?
It's going to depend on situation, but ultimately, if you've got the finances to buy without and leave the money in there, that's a good option. Because long-term interest rates are always going to be lower than long-term growth market growth. But it's specific to people. If it's a part of your deposit, And just on that, one of the things you need to be really careful of is as you approach buying a first home, you got to then choose your asset allocation. You can't be aggressive. Because if you think you've got 50,000 deposit and the market drops by 10%, you're short deposit. So the biggest determinant how aggressive or not aggressive you are is time horizon. Not your bias, not how you feel about market loss. It's how long are you going to be in.
Can we talk some real numbers around the difference between, say, a young person being in a conservative or balanced fund for their life versus being in a aggressive fund? What does that mean?
Well, I use this scenario here, and for me, it's young. For you, probably not. So, and for Ben, it'll be young. But we look at 35-year-old. I've called him Donald just to create a bit of controversy.
Donald.
Earning 100,000 per annum and contributes a monthly minimum of 3%, company 3%, and it starts with a 50K balance. In a conservative fund, the estimate when he's 65 will be 270,000. In a growth fund, you'll have 387,000, and an aggressive fund, 468,000. So you're looking at a $200,000 difference over your time span, just by being in the right or wrong fund.
And does that assume that poor Donald has no pay rises?
Well, it seems no legal battles as well. But yeah, so
Those can be quite expensive, I hear.
yeah, they can. But it's all peanuts. It's all fiat currency. So,
Exactly.
But yeah, that makes a huge difference. That's a comfortable retirement, part of a plan, or a big drop in what you can look forward to.
If you're self-employed, Dita, should you be contributing to KiwiSaver, or are there better options out there?
Again, as we said in the beginning, a PAR fund is not necessarily within a structure that has to be a KiwiSaver. So if you are focused to flexibility financially and you want options, I would look at putting the minimum into your KiwiSaver to get the government contribution,
Which is what?
$1,042 a year,
Which means you get what back from the government?
$521 back. So you get a 50% return every year just on what you put in, which is not a huge amount, but hey,
Right.
who's going to kick a 50% in the mouth?
So I'm your client. You're telling me that I should just put in $100 a month into my KiwiSaver, which is what I am doing, by the way.
But then you can always invest in a structure that gives you options. If you're a really successful business and you want to stop at 55, you don't have to wait to 65 to access a fund that hasn't got a KiwiSaver regulation around it. So
Sure.
it's all about your journey, your flexibility, your goals.
And so what are people doing? Do you think people are doing things wrong in New Zealand on average? And do you think the majority of New Zealanders aren't getting the most out of their KiwiSaver? And what can you guys do for them to then help them get the best out of their KiwiSaver?
That's a good question, because that is the practical side of the rubber hitting the road. And as an example, back in 2020 when the market dropped in March 2020, we had about 1.4 billion switch from growth to conservative. Now, you just think about getting off the lift at the ground floor. The lift went back up again.
Basically the worst thing you can do, Just right at the bottom.
You're never going to recover that. So the other thing you need to consider is not all the fund options are the same. Within the growth fund sector, you've got the lowest performer at 4.7% per annum over 5 years. The highest is 10.7. So even within each option, there's a wide range. So my job is to basically understand what you really need it for. What's the time horizon? How does it fit into the big picture? Research all the available funds and providers, and then give advice specific to you.
Real talk. Some real clients of mine, let's call them Donald,
I was going to say, brilliant.
Melandia.
Donald and Daffy.
Donald and Devlin, they sat down with me for an initial insurance consultation a few years ago in the middle of that crazy time. And I said, okay, what's your KiwiSaver balances? Because we go through a financial needs analysis questionnaire. And they said, both about 30,000, but it was 46,000. So our KiwiSavers dropped, and then we read a Stuff article, and so we shifted our KiwiSavers from aggressive to cash. They literally both locked in a $15,000 loss, and they didn't understand what that meant. And I was just kind of sitting there dumbstruck, Anyway, in terms of accessing advice, you provide a full planning service, but you also provide just KiwiSaver specific advice. and there's like a deal for platform listers or something, isn't there?
You're always pushing me on a deal.
Yeah, let's get this going.
The art of the deal.
Yeah.
Man,
Oh dear.
next minute I'll be charging in rands.
We stop referencing. Yeah. Rants. Yeah. No, you still got to charge, but and can you talk about what that actually looks like as well?
Yeah, so it's basically an advice pack which includes access to the planning software, which is ongoing. So we're not going to pull it away. It basically we sit down and we go through that. You fill in your information. We do an alignment session. I give you a statement of advice specific to your needs around KiwiSaver, and then we implement. And then what we'll do is we'll have the option for an annual review, which will be a small fee as well because there's not really, it needs to cover the cost of being in business.
So sorry if I get this wrong, but normal price for that is $500. But
it is.
And what are you charging platform listeners?
50% less, so $250.
Okay. Good deal. Good deal.
Well, a very good deal if it's going to mean that at retirement you are $300,000 to $400,000 better off.
Very much so, because actually it's not about my fee. It's not about that. It's about actually being in the right space for your journey. And there's a typical DIY culture here. I've come across that a lot.
Yeah,
she'd be right.
Yeah, exactly.
And exactly, you're saying just put it and lock it and leave it. What you think is good. But you need to review your situation yearly at least, and that's where accountability comes in. It's actually sitting with someone and going, why are you doing this? What was the purpose? Oh, actually, I thought it was going to be this. So you reduce the length of mistakes and bad decisions, and you improve the good decisions every decade, when that's going to compound at the end of the day.
Yeah. I have one more question there, and it's about how late is too late to start a KiwiSaver. 49 and don't have KiwiSaver, only works part-time, so don't earn much. Contributions will be 3%. Have I left it too late to start a KiwiSaver, and is there any point given I don't earn much?
It's never too late.
It's never too late.
This is what you guys say. It can never be too late to start saving, start thinking about it. Yeah.
Yeah, if I said to you today, I'll give you $10,000, would you say no?
No, I wouldn't say no.
So you got to think about it. You do that, compound it over time until 65, and someone's going to give you some money, whatever that's for. It's more money than you would have had if you didn't do it.
Because at the very least, the government will give you $500 a year in free tax rebates.
So free money.
Yeah.
No such thing as a free lunch.
The greatest myth of all.
Yeah. Absolutely. Fascinating as always, guys. Thank you very much for coming back in for Money Matters. We'll play that intro, Josh. Outro,
Sam and Dieter from Harness Financial. To make the most out of your money matters with Sam and Dieter from Harness Financial. To make the most out of your money, visit harnessfinancial.co.nz.
Yep, and just quickly, if you want to reach the boys, harnessfinancial.co.nz, and any...
Sam Rees Thomas for insurance advice on 027 3344812, and Dieter Timmerman for investment and KiwiSaver advice on
0210 268 7955.
Brilliant.
You caught me with my name, but said it wrong.
Good stuff. That was Money Matters. Let's go to a break.
Your money matters with Sam and Dieter from Harness Financial. To make the most out of your money, visit harnessfinancial.co.nz.